And welcome to the Aaron Katsman Show. I'm your host, Aaron Katsman. We speak to your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. And if you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And there is nothing that says that if you know somebody who might actually find this content interesting, that you can't share it with them. That's why there's that little arrow down below which says share. So why don't you go ahead and do that as well? So I came across a fascinating article, as I often do, written by Ben Carlson from Ritholtz Wealth Management. And the title of his article was The Top 10 Stocks in the S&P 500. And this is something that I've spoken about a lot. And it's one of the main drivers, one of the main reasons that I think that more and more it probably pays for investors to focus on investing in ETFs or index funds as opposed to trying to play stocks. So he starts off like this. He goes, a reader asks, do you think the S&P 500 top 10, right, the top 10 stocks in the S&P 500 will change over the next 10 years? So he says that he's actually been doing an analysis and he ranks the top 10 stocks every 5 years. What's really, really interesting is if you look, the top 10 today versus the top 10, let's say in 2020, you've got companies like Johnson & Johnson, Walmart, Visa, which fell out. They're still big companies. They all fell out. They're no longer the 10 biggest companies. They've been replaced by the likes of Eli Lilly, Broadcom, and the like at NVIDIA. So what we see, and if you look back over, I'm not going to bore you with every 5 years, but there's generally like a few, 3, 4, 5 companies every 5-year period that flip out of the top 10 holdings of the S&P 500. Fascinating. So he says, there are companies that can stay in the top 10 for a very long time. IBM was in the S&P 500 until 1990. They were at the top of the heap all the way back in the 60s. Exxon had a good run for almost 55 years, from 1980 until 2015, until they dropped out, right? We know that GE was the biggest stock in the world for many, many years until the financial crisis ended up sending them back to earth. Microsoft, Carlson says, first made an appearance in 1995 and has more or less been in and around the top 10 ever since dropping out a few years ago during the dot-com bubble burst. Apple's been on a nice run, right? So we see there are companies even today that have been in there for 20, 25 years, but there is plenty of turnover. Carlson says he counts, he goes back to 1980. So he said there are 100 slots since 1980. He calls 100 slots every 5 years. I count 42 different companies in total. So on average, there's roughly 4 new companies that enter the top 10 every 5 years. Plus, there are lots of companies that jump in and out between these periods. Tesla is not in the top 10 right now, he says, but they were just a few months ago before the stock crashed. So he says, in short, yes, I think the top 10 will change over the next 10 years. What I don't know is which stocks will drop off and which stocks will take their place. Now, what's really interesting is this. He says in Stripe's latest annual letter, the Collison brothers described how innovation is speeding up turnover in the S&P 500. Quote, the U.S. corporate sector is both the cradle of innovation and a densely populated graveyard of companies that had fabulous futures in their pasts. I love that. Of the 500 companies in the S&P 500 at its inception in 1957, only 53 remain in the index today. Back in 1957, companies could expect to remain in the index for 61 years. In 1980, the average tenure was 36 years. Notice a pattern. Today, it's just under 20 years. Enduring businesses are increasingly rare, right? So what do I take from that? I think that's fascinating. And it also means that it is very difficult if you're going to be trading stocks to know which stocks to pick, right? I've said this a lot. The beauty of indices is that in some ways they're dynamic, right? The hot stocks of today, I don't want to call them hot, right? It's facetious. But the today's leaders may not be tomorrow's leaders as well. So when you own an index, they're constantly regurgitating. That's not the right word, is it? Regurgitating. Oops. They're constantly revamping the index based on the criteria, right, that the index makers use. So you're constantly sort of keeping up with you're sort of modern, right? You're always with the innovative and cutting edge companies, which are showing their cutting edgeness through market capitalization, right? How big they are. Whereas, when companies falter, they drop out of the index. They might drop out, if you're talking about the S&P 500, they might, drop out altogether, or, they'll drop out of the top 10 or the top 50, where they become much less relevant in the index. They have much less of a weighting in the index. It doesn't really matter so much what happens with their stock. Whereas if you're trying, I can't tell you how many clients I have. I see clients who come in, they've held Johnson & Johnson for 40 years, Exxon, AT&T, right? So sometimes you get big winners, sometimes you get companies not so good. I think that's going to be less and less common as we go forward, because just the rapid change of innovation and the fact, like I said, that you're talking about a very short time horizon in the greater scheme of things, that companies stay in the index. So as such, it seems to me, at least, that you can take from this that it probably pays to invest in indices as opposed to trying to trade individual stocks, because things move so fast. And for the average investor who doesn't have so much, doesn't have any better information than anybody else has, and has to have, his hand on the pulse all the time, the chances are you're not going to do as well. Whereas if you just ride the indices, whether it be, small cap indices, mid-size S&P 500, whatever it is, you're always going to be sort of updated with today's latest and greatest. Okay, just interesting food for thought. But I came across the article and I thought, wow, that's really interesting. And it sort of fits into a motif that we've spoken about here many, many times. You've been tuning into the Aaron Katsman Show. We speak about your life, money, and your investments. If you found this interesting, hit the like button below. If you've not yet done so, please remember to subscribe to both the podcast and to the YouTube channel. If you found this is interesting, if you've got somebody out there who I like trading stocks or whatever, maybe they'll find this piece interesting as well. Thanks so much for tuning in. We'll speak to you soon.